Shallow men believe in luck. Strong men believe in cause and effect. Ralph Waldo Emerson. My friends, 10 to 15 minutes a day, that is all we ask so that you are able to follow these charts with us, learn what there is to learn, particularly weekly vertical crossovers, and of course, how to read all the signs on these charts. The price percent oscillator, the derivative oscillator, how to use the exponential moving average, which we call the signal line, with the price percent oscillator, what the 50 period moving average line and the 200 period moving average line mean to us, trying to find floors and ceilings. And then on the top of the chart, the Bollinger Bands, which are what? They are our volatility bands. They show us when volatility increases, they spread farther apart. When they get closer together, volatility decreases. It's when they start spreading. And again, you can look at the chart and see it. And you can see as they get tighter and tighter ranges when volatility is decreasing. But again, that's important to know. Also, how to read the Heikin-Ashi candlesticks, how to draw and use trend lines, all sorts of important stuff. Let's jump into these charts. Thank you again for all of our Patreon supporters. Remember, we have that special options training for free for our Patreon supporters, the monthly question and answer session. And of course, every week, the 10 weekly vertical crossovers up and down. When they're not enough up or down, we always fill you in with the opposite, because typically when there's only 4 or 5 crossovers going up, there are many more going down. That also gives you a clue as to where the stocks are moving in the S&P. Now again, it may not be the largest volume, but it will show you where the stocks are. So let's jump into these charts. What do we see going on? Well, we had a weekly vertical crossover going down back on the week ending the 21st of May. What do we see happening? Not enough energy. We have a divergence here. The market is trending up. Now, the high last week was 422.92, 422.78, so we've not hit a higher high this week. We do see a green up candle that has been forming. The market actually down for the day, 0.08%, but this is a Heikin-Ashi candlestick. Remember, those are drawn differently, and to understand that better, at the end of today's video, I'm going to put in the Heikin-Ashi training just for you. You'll see the link at the end of the video. If you don't know what Heikin-Ashi candlesticks are all about, we've got a great training on a couple of 100,000 people have taken it. You can be one of those. Now, what do we see going on as far as the Heikin-Ashi candlestick goes? Well, it's not reaching a higher high at this point. Gives you the illusion of moving up. The average pace is showing you that. But what do we see on the most important price percent oscillator? I keep knocking that derivative oscillator, but it's the price percent oscillator. What do we see there? We see that it is continuing to trend down, actually pulling away from the red signal line. That's the divergence I'm talking about. As we move up higher, that price percent oscillator is not getting higher. The derivative oscillator is devolving also. That's important to pay attention to. It's showing you that where this movement is over these last 3 weeks or 2 weeks and a day is very, very shallow in the depth that it has as far as that momentum goes, because the devolution of both the derivative oscillator and the price percent oscillator are showing us inherent weaknesses in that movement, so be ready. Look at the 2-day chart. Not enough energy for even it. Now think about that. It is 2.5 times smaller than the weekly chart, and there's not enough energy there for it to cross over yet. The derivative oscillator is losing momentum. Price percent oscillator has not crossed. When we look at this latest 2-day candle, we can see where it boomed up. That must have been on Friday, because this is the Friday-Monday candle, after things were devolving on that Wednesday, Thursday candle from last week. So as we look at things, again, we are again seeing weakness in there. Now, look at the half-day chart. It did manage to cross over in the afternoon on Friday, but then again, it's showing weakness on Monday, both in the morning and in the afternoon in particular. We do see that price percent oscillator trying to slowly move away from the red signal line and the derivative oscillator gaining momentum. But again, remember, it's our smallest chart. So we'll continue to watch and see. What would I like to see happen? I wouldn't be upset if we had a 2-day crossover going up. Why? Because when it moved back over going down, then that would, of course, give us a 2-day recross if the weekly continued in its downward momentum to be able to feel more comfortable jumping in for a down move. That's where we are on the S&P. The Q's a little different. Again, we look at the high from last week on the Q's, 336.06, the high 336.66, so it is reaching a higher high on Monday than the prior week. It was up for the day a little bit, 0.30, as opposed to the S&P being down 0.08. However, price percent oscillator still down, derivative oscillator still negative, losing a little bit of downward momentum. Now, check out the 2-day. I've already put this in. The 2-day is a crossover going up. It crossed over this last week, actually bounced off the red signal line going down. That happened on Tuesday of last week and now has bounded back over trying to go up. Derivative oscillator gaining upward momentum, price percent oscillator heading up. We see on the half-day chart some struggling movement in the morning on Monday and then up higher in the afternoon. And of course, that crossover going up in the morning. So we'll continue to watch and see just what's going on with both of our indexes, the Qs and the S&P 500, both of them with some inherent weaknesses in them. But again, market's still trying to keep its act together and move up. What do we see on 20-year bonds? We see they are down for the day 0.31%. We look at this weekly chart. We had a weekly vertical crossover back on the 30th of April. Things then slid sideways the next week, down the 2 following weeks, and over the last 3 weeks trying to gain some momentum. Price percent oscillator stayed positive the entire time. Derivative oscillator gaining a little momentum on Monday. Price percent oscillator has slowly tried to pull away from the red signal line as things have gone along. We look at the 2-day. Same here. The 2-day crossed over going up back on the 20th of May, then boomed up for 4 days, sliding sideways and down for 6 days, and then over the last 2 days, booming up again. Let's look and see where we are as far as the high 139.90, that prior high on the 2-day candle, the 25th and 26th, 239.91. So again, just 1 penny off, hitting that prior most recent high as the price percent oscillator pulls away from the red signal line, derivative oscillator gaining momentum. We can see on the half-day chart where things boomed up on Friday and then not as much on Monday, in fact sinking, like I said, a little bit, 0.31%. So we'll continue to watch and see how bonds continues to play out. You notice how bonds, and this is important to pay attention to, how bonds are staying positive, okay? And look at what's happening on the weekly chart with stocks. They're staying negative. Isn't that interesting? Isn't that interesting? Even though bonds have struggled to stay positive and stocks have continued to invariably try to move up. Is that telling you perhaps what the market is trying to do? Remember, when the stock market's not doing well, where does the money flow to? Typically to bonds is more of a safe haven. So it is interesting as these two opposites tend to be moving in the directions you would think if the market were going to have some serious troubles. Again, it is an interesting time. I mean, you guys know that typically, those who've been with me over the years, summertime trading zone typically stinks. Sell in May and go away, live to trade another day. That usually means that the big money's out of the market. You've got, again, not a lot of volume, so the market's sort of here, there, and everywhere. Makes it very difficult to do much. We're waiting to see how, as we get into just the full-blown summertime trading zone, if that's going to happen. That did not happen this last year for the first time that I've ever seen. So again, very curious as to how things are going to continue to go this summer. Let's leave bonds and stocks and go to gold. Again, I told you how long I had been waiting for gold to cross over going up. It's just been beautiful. It did back on the week ending the 23rd of April. And what's it done? It's gone somewhere from the 166 mark to the most recent high of 178.85, starting the week off slower. How is that? We have a red open box candle. Now again, that's a slowdown in the up movement. Nonetheless, gold was up for the day 0.40%, but it's not hitting the high that it hit this last week yet. 178.85 last week, so far 177.90. You can also see the price percent oscillator is moving up. It had a stronger angle 2 weeks ago, but it's still moving up. Derivative oscillator, likewise, because of this slowdown, has lost a little bit of momentum. Look at the 2-day chart. It had been heading down. That actually reflected some down movement over the course of the Wednesday-Thursday candle of last week. And then we see this latest one, almost a doji, again showing indecision. Price percent oscillator had been heading down. Now it is more flat. Derivative oscillator losing momentum. So pay attention in case gold is getting ready to stop its run. What do we see on the half day? It crossed over going down all the way back on the afternoon of Wednesday or Thursday morning. That would have been the 26th or the 27th. After that, we saw gold tick up, and then we saw that big hammer down on gold in the morning and in the afternoon on Thursday, the 3rd of June. Since then, it's been tracking back up steadily. Derivative oscillator still negative, losing downward momentum. Price percent oscillator negative. Looks like it's trying to move up toward the red signal line. So we'll continue to watch and see just where gold is and where it is going. And this got drawn the wrong way. Bottom up, top down. Let's draw that a little better. Well, I know why I drew it that way. It's because it is rather screwed up. I started just to leave it here. Maybe I just should. That way it'll be less confusing. Top down. When you're drawing candlesticks, that is the way you do it, although we have it tracking up and still negative. So I was confusing myself there. Sorry about that. Now, let's lastly go to Bitcoin. Bitcoin, no movement for the day. Has Bitcoin hit its bottom here around the 336.60 mark, so $36,600 or so mark? Is that where Bitcoin's going to bottom out? Maybe. Maybe. We look at the weekly chart, however, it's telling us that there's still a lot of downward pressure. The derivative oscillator is slowing in its down movement this first day of the new week. But still, that pressure is down with that price percent oscillator. But we can see where things are sort of hitting around the same bottom. Now, it could just be digesting the losses and getting ready to hammer down again. We look at the 2-day chart. It's still moving down. Again, it's lost some of that downward momentum. Derivative oscillator losing downward momentum. Sliding along the bottom here. Could be getting ready to accelerate up, could be getting ready to just fall off the cliff again. Half-day chart, again, we can see where it's been all over the place, even though it has been tracking up since it crossed over going up back on Wednesday morning, the 26th. Went up Wednesday and Thursday of that week, then down and sideways and up and down. So we'll continue to keep an eye on Bitcoin. Main thing to remember, still a lot of downward pressure on that weekly and 2-day. We'll see when Bitcoin bottoms, things cross over on the 2-day going up, and then it carries over on the weekly. We'll feel a lot better. How well did we do on that last crossover on the weekly? Oh, I don't know, a jumping in point around 12,000 and a high of what? 60? Not bad, my friends, not bad. Not bad. Well, we wouldn't have quite got there. In fact, we would have gotten out on the 2-day most likely. So wouldn't have captured all of that. I mean, at least would have gotten out on the 2-day somewhere probably around that $50,000 mark, which would have been good enough. You don't have to get it all. You get that big chunk out of the middle. Would 40,000 be enough for you? 30,000 be enough for you? Again, these are practice trades. We're not a stock calling service. We're not a Bitcoin calling service. We're an education firm. You need to practice. Practice to show yourself approved and to show yourself you know what you're doing. Otherwise, you're going to get hammered. My friends, God bless you. Thanks for all your support and help. Thanks for listening. Be sure to like this video, subscribe to our YouTube, subscribe at chartingwealth.com to get all of our special daily trainings. We have a great one for you today. It is called Backtracking, Using Stock Charts to Find Trading Patterns. Man, that's the number one thing, one of the number one things you need to know. God bless. All the best from the whole team at Charting Wealth World Headquarters.